India is a large country, but even today, most of its population does not know how to invest in stock market and how to do investment management in general. And especially, most people don't know what are the rules and regulations surrounding the investment area. So in this video, I'm going to be talking about what are the regulations that an investor needs to keep in mind while doing the investment, especially for the mutual fund. Now, before we begin, please keep in mind that this information that I am giving is a bit older, so it is always advisable to connect with your advisor or look at the mutual fund and SEBI website to get the latest rules and regulations in place for mutual. Know your customer. Investors are required to complete KYC formalities, which involve providing identity and address proof in accordance with SEBI guidelines. SEBI introduced a riskometer that categorizes mutual fund schemes on a scale of 1 to 6, indicating the level of risk associated with the scheme. SEBI has also set limits on the total expense ratio, which represents the expenses charged by mutual fund houses to the investors. These limits vary depending on the type of schemes that you are investing in. Next is categorization and rationalization. So SEBI has categorized mutual fund schemes into equity, debt, hybrid and other categories. This was done to bring uniformity and clarity in fund offerings. SIP and STP timing. SEBI has standardized the timing for processing SIP, which is Systematic Investment Plan, and STP, which is Systematic Transfer Plan transactions. This is typically done on exit load. Mutual funds are allowed to charge exit loads, which vary depending on the duration of investment. SEBI regulates the maximum exit load that can be charged to investors for exiting early from the scheme or exiting in general from the scheme. Direct and regular plans. Investors have the option to choose between direct and regular plans of mutual funds. Direct plans have lower expense ratio as they do not involve distributor commissions. Consolidated account statement or CAS. So SEBI mandates that investors receive a CAS or consolidated account statement that provides a consolidated view of their mutual fund investments across fund houses. This helps them in understanding where their money is at this current point, what is the portfolio value, whether they are making profit over it or whether they are making loss over it. Asset Management Company or AMC regulations. SEBI has laid down regulations governing the functioning of asset management companies, including their capital requirement and governance. This helps investors feel more secured, and SEBI also regularized that anybody who is in the business of investment has enough capital reserves for the rainy day. Mandatory risk disclosure. Mutual funds are required to disclose the risk factors associated with their schemes prominently in their offer document. So this gives an idea to the investor of the risk that they are associating themselves by investing in that scheme. So with that said, I hope I have given you an eagle's eye view over how the investment rules and regulations affect the regular investors or a daily or day-to-day investors who does not know much about the investment horizon and does not know how the mutual fund houses could use sophisticated language to make sure that what they don't want to instruct or what they don't want their investors to know wouldn't know. I also hope you like this video. If you like the video, please share it with the people that you know so that they also become aware about the rules and regulation scenario in India. And if you are looking for any kind of investment opportunity or are interested in wealth management, please get in touch with us. I will leave the information in the description box below. With that said, take care. Bye bye. I will see you in the next video.